Hi everyone, this is Mariana Subasic from Northeast Wealth. I'm one of the financial advisors here, and today I'll be running you through the autumn 2023 economic update. As always, the information I'm going to share with you is general only and does not include any of your personal situation, objectives, or goals. And again, should you wish to speak to us and have any questions, please reach out to the team. We're always here to help. Let's get into it. The key areas that I'll be covering off today, as you can see on the screen here, are inflation, the rise in interest rates, looking at the Australian share market and the US share market, and last but not least, the Australian property market. Let's get into it. So looking at inflation, the CPI rose by approximately 1.9% last quarter, and in 2022, it rose by 7.8%. Now, the Governor and the Treasurer have agreed that the appropriate target for monetary policy in Australia is to achieve an inflation rate of 2% to 3% on average over time, as you can see in front of your screen here. The next release is expected end of April, so that should be coming through anytime now. According to a lot of leading economists and the central bank itself, they're predicting that CPI will continue to rise towards the end of 2023, followed by a decline in 2024. Looking at cash rates, so on the 4th of April, the RBA left the cash rate as it is, and currently that is 3.6%. The next meeting is scheduled for early May, so that should be coming through soon, which will obviously hear the next announcement. Now, 3 of the 4 of the big banks have predicted that May will see another rise, which will inevitably bring the cash rate up to 3.85%. Looking at lending interest rates, and as you can see on the screen here, this graph depicts the last 3.5 years and the comparison of outstanding loans, so the darker red here, compared to new loans. What we can see is there's been a pretty sharp increase by approximately 2% over the last 3.5 years. What that means for an average home loan is if you had $1 million home loan, they'll increase your interest by $20,000 per year. What we're also seeing is business lending basically having the exact same trend and increasing by approximately about 2%. Now, the fixed rate cliff is becoming quite a common term that we're seeing right now, and it's essentially one of the bigger risks to the housing market, as well as overall economic stability of 2023. It's estimated that $400 billion worth of fixed rate loans are expiring this year. But the true test or the outcome of that will really be seen towards the end of the year or over the next sort of 10 months or so. Now, we've compared just a difference for a standard sort of home loan at, let's say, $538,000. If that rate was fixed at 1.98% back in April 2021, your repayments were just under $2,000 per month. That increased to 5.48%. We'll see the monthly repayments up to over $3,000. So for an average household, that's increasing the repayments for just under $13,000 per year, which obviously is a pretty significant increase, especially in a short amount of time. As always, we are here to help manage that and see the impact of that. So we'll send through a link for being able to download our Northeast Budget Planner, which really allows you to compare what your current repayments are to what the new repayments will be. And more importantly, you can really see what is going to be the overall impact to your 5-year projected savings balance. And you can really see that and try and plan for it. Moving on to Australian shares. So basically the ASX 200 is one of the more important stock market indexes in Australia. It tracks the performance of 200 large companies in Australia here across the country. Over the last 12 months, we've seen a return of negative 0.4%. So it's been pretty steady over that period. However, what's interesting to note is that the Australian share market indexes have actually outperformed a lot of their peers during that time. Now, looking ahead for 2023, as you can see on the screen in front of you, there's a pretty big range between an optimistic AMP, closing the market, the ASX 200 at 7,600, whereas the Credit Suisse is 6,700. So the pricing is quite different. Again, it just reiterates how much variability there is in a lot of those predictions. Some key factors to consider that will impact the share market, as you can see here, is China reopening as they're our biggest importer of raw materials and energy. Obviously, the tightening financial and monetary conditions, the fallout of the rate hikes, as we've already covered. Looking at further impact of the Ukraine war especially on our supply chain, as well as the likelihood of recession, again, globally, as well as then the impact here locally. Moving on to the US shares over the last 12 months. So on the screen here, we're looking at the three of the biggest US share indexes. And as you can see, the returns of the last 12 months I've highlighted here. So, the Dow Jones has done negative 0.07. The S&P 500 in the US has done negative 3.32. And the NASDAQ stock market has done negative 6.07. Some commentary around what they're expecting for the rest of the year. So the New York Fed's recession model predicts a 54% chance of a US recession sometime in the next 12 months. Again, some key factors that will impact what this will look like. It's very similar to the Australian market. So inflation is going to be a big one. Their range was at around 6% back in February, and they're expecting that to jump up to about 7%. Interest rates, again, will impact that. If you think about it, the higher the interest rates are, the more expensive it is for companies to borrow money to, again, invest in growth of their companies. Some disappointing earnings. So a lot of the S&P 500 companies continue to see a decline in a lot of their key financials, with earnings expected to, again, decrease for the rest of the year. Again, geopolitical events, the Ukraine war, rising tensions between China and Taiwan as well, will be an impact on the US share economy. Supply chain disruptions, again, seeing what the war's done recently, and the impact of, if that continues and how that continues, will impact a lot of the share markets across the world. Some further commentaries has been that, whilst the supply chain especially has had some moderate improvements in the earlier 2023, there's still a long way to go. So the impact of that is still yet to be seen. Moving on to the Australian property market. Looking at the last 12 months here, across the country, we've seen a negative 8%. Mostly you can see has been a negative change in dwelling values. This is as at end of March 2023. There's been some key performers, so regional WA and regional SA have actually been positive. However, most, especially across the cities, has been negative. Something important to note here is that even with falls up to about 10%, the national property prices, they'll still be more than 18% above the pre-pandemic levels. So again, forecasting for the rest of 2023, there's a lot of talk around a range between sort of -7% to negative 10%. Again, there's a few key things that will impact this, more rate hikes, but what's important to note is that once interest rates peak and inflation peaks, consumer confidence is likely to return to the market, and will impact or will act as like a reset as the new property cycle begins. So what we're seeing here is that the next stage is going to be more of a stabilization phase of the property market, which again will take time to see. And that is all I have that I wanted to cover off for today. So as always, if you've got any questions or queries, please reach out to the team. We're always here to help. Hope you've enjoyed and taken some key outcomes. Thank you.